On a grey Thursday morning in London, economists and analysts huddled around their Bloomberg terminals awaiting the latest UK inflation numbers. This monthly data drop is always a big deal, but this release carried extra weight after the Bank of England had been furiously signaling that an interest rate cut could be in the offing if price pressures continued to abate. The numbers hit the tape, and there were both sighs of relief and sharp intakes of breath. Headline inflation had indeed fallen, dropping from 3.2% in March down to 2.3% in April. Finally, price growth is nearing the bank's 2% target after a brutal bout of pandemic-fueled supply shocks and soaring energy costs in the wake of Russia's invasion of Ukraine sent inflation ripping toward double digits over the last 2 years. For a nation ravaged by runaway prices and painful interest rate hikes required to corral them, this week's report seemed like a welcome respite. Prime Minister Rishi Sunak crowed that the UK was winning its battle with inflation, and declared the return to normal price levels a major moment for the economy. But look beneath the headline and a more worrisome picture emerges. Far from vanquishing its inflation demon, Britain's increasingly sticky and pernicious price pressures reveal the harsh residue of supply shocks, labour shortages, and a global wave of monetary tightening still working its way through the economic plumbing. The depth and duration of this disinflationary slog highlights the existential choice now vexing central bankers the world over. Do they stick to the strict anti-inflation regime that has defined modern monetary policy, a path that inevitably requires further economic pain to definitively wring out the virus of spiraling prices and unsustainably high wage growth? Or at some point, do they decide that inflation is tamed enough and pivot towards forestalling a deeper recession at the risk of letting price pressures linger? For the Bank of England, with the UK economy still exhibiting considerable momentum, that fateful decision on how much more medicine to apply has been made harder by the nuances buried in this week's inflation numbers. While the top-line 2.3% print was slightly higher than expected, it was really the details on core inflation and particularly the stickiness in services prices that set traders rethinking the near-term interest rate trajectory. Core inflation, which strips out volatile food and energy prices, clocked in at 3.9%. Down from the previous month, but still remarkably elevated for an economy meant to be in the grips of a disinflationary trend. But it was the obstinance of prices for services, everything from haircuts to sports tickets to software subscriptions, that truly gave hawkish Bank of England policymakers pause. Year-over-year services inflation was still running north of 5.9% in April, well above economist forecasts of 5.5% and a level that suggests domestic price pressures remain far too heated for comfort. Services CPI inflation is the best gauge of underlying inflation, and this remains uncomfortably high, said Tomasz Wieladek, an economist at T. Rowe Price. The data today clearly show that markets were too optimistic about a June cut and remain too optimistic about BoE cuts this year. As Fed Chair Jerome Powell has been at pains to emphasize, monetary policy works with a lag, and the labor market is the key transmission mechanism. In the UK, like in the US, the jobs market remains extraordinarily tight, with unemployment near 5-decade lows and job vacancies still considerably outpacing available workers. This fundamental imbalance of too many jobs chasing too few workers has juiced up wage growth well above the levels the Bank of England deems compatible with its inflation target. In its latest forecast, the bank projected wage growth would moderate to around 5.25%. But with private sector pay running closer to 7.5% on an annual basis, the risks of a wage price spiral taking hold increase with each passing too hot jobs report. Despite the stubbornness of services inflation and wage pressures, some economists still clung to the hope that the BoE would follow through with a modest 25 basis point rate cut in June. That view was predicated on a belief within market circles that the central bank was perhaps getting a bit too singularly focused on lagging wage figures, and too dismissive of easing pipeline price pressures evident in other gauges like producer prices and consumer goods inflation. Yael Selfin, chief economist at KPMG UK, summarized this perspective, saying this may still not be enough to convince more cautious MPC members to commit to a rate cut in June, especially while wage growth remains elevated and economic growth momentum is strong. But with headline inflation now within striking distance of the 2% target, there is a strong case for an insurance cut to get there, particularly with plenty of headwinds facing the economy. That case for insurance easing, delivering a modest dose of stimulus to ensure inflation keeps trending down while buying the economy some insurance against stalling growth or unnecessarily harsh tightening, is one embraced by Fed policymakers too. With inflation also slowing in the U.S. amid rising recession fears, Powell and his cohorts have strongly hinted they could pause rate hikes in the coming months, even if that means living with inflation running somewhat above their 2% goal for a while longer. The risk with this approach is that by stepping too lightly, the central bank allows inflation expectations to retrench, making the eventual task of reining in prices even harder and more economically disruptive down the road. Just ask the Bank of Japan how difficult it is dislodging embedded expectations of low inflation or deflation. The Bank of England seems inclined to avoid putting itself in that predicament. Despite the drop in headline inflation, rate futures trading in the wake of the latest numbers showed markets rapidly marking down the probability of any rate cuts over the remainder of 2023. Investors now seem to be pricing in at most 1/4 point reduction by year-end, a far cry from the 225 basis point cuts that had been baked into market forecasts just a few weeks ago. Andrew Bailey, the BoE's governor, made clear in recent commentary that while he welcomed the moderation in overall price growth, he believes it's far too early to declare victory. We have had a real issue around inflation becoming embedded in pricing behavior, in wage negotiations, and in inflation expectations, he warned. We have got to be absolutely sure before we make any signal on there being a risk of going off course. Those searing words seem to confirm the bank will not be cowed by transitory dips in inflation, however welcome they may be. Rather than settling for a muddling, start-stop path riddled with premature pivot points, policymakers seem determined to lean against inflationary forces until the UK has definitively crossed the threshold into a new, low, and stable inflation regime akin to the relatively placid backdrop prior to the pandemic. In the bank's view, a little more short-term economic turbulence is a small price to pay to ensure Britain draws a clear line under this inflationary outbreak and doesn't find itself constantly grappling with revived bouts of pernicious price pressures down the line. The risk of under-tightening is seen as greater than over-tightening at this stage. This hardline posture aligns the old lady of Threadneedle Street with the increasingly uncompromising inflation-fighting rhetoric emanating from other major central banks. After initially hoping they could cool inflationary pressures through modest rate rises and deftly orchestrated soft landings, the world's big monetary authorities have been forced to continually ratchet up their policy rate forecasts and adopt a more emphatic tough-on-inflation tone. Making this pivot has come at substantial economic cost. After unleashing the most acute tightening of financial conditions in 40 years, central bankers now confront the inevitability of inflicting recessions on major swaths of the global economy, but their refrain has become one of better to rip off the inflationary band-aid cleanly and endure a shallow downturn than dawdle about and potentially seed the ground for an even deeper and more protracted slump down the road fueled by unmoored inflation expectations and wage price spirals. So while some fretted that unexpectedly elevated British inflation figures for April could prompt the BoE to stall or scale back its tightening plans, policymakers themselves see sticking to their disinflationary guns as by far the lesser economic evil. The fear of falling back into the dire 1970s-style bout of rolling stagflation breeds a kind of psychological hardening among central bankers. An unwillingness to change course until they are absolutely certain the inflation genie has been fully rebottled. Having already been forced to administer larger and more sustained interest rate increases than virtually any economist predicted would be necessary at the pandemic's outset, the last thing monetary authorities want is to ease up prematurely only to be dragged into an even more draconian tightening cycle down the road. This mentality was evident in the distinctly hawkish tone struck by Bank of England officials in the wake of April's mixed inflation signals. Andrew Bailey insisted the central bank has had a real issue around inflation becoming embedded in pricing behavior, in wage negotiations and in inflation expectations that cannot be forgotten or discounted too hastily. Ben Broadbent, the BoE's deputy governor, delivered similarly stern remarks. Persistently strong wage growth and strong demand mean we'll have to go further to get inflation all the way back down. The bank's chief economist, Hu Pil, piled on further, warning that while goods price inflation may be in a ferocious decline, the services sector was exhibiting distressingly sticky inflation dynamics. And crucially, it is the evolution of services prices, tied more directly to domestic demand conditions and labor costs than volatile goods prices, that the BoE is focusing its recession-fighting policy artillery on. So for all the hosannas greeting the slowing inflation rate from politicians eager for an economic win, the Bank of England shows no signs of being anywhere close to claiming mission accomplished. They remain laser-focused on the reality that underlying inflation still has frightfully long tails, ones that could easily morph back into destabilizing runaway price growth dynamics if not decisively severed by sufficiently restrictive policy today. This is the harsh governing reality for all the world's elite monetary institutions. Perfunctory bouts of disinflation or cost of living relief born of transient commodity price declines have to be treated with extreme skepticism in the current environment. Only a thorough, broad-based, and sustained retrenchment of inflation across the full spectrum of consumer prices and wage costs will suffice to finally declare the battle won. And until that point is reached, liberal democracies must brace for unrelenting anti-inflation hawkishness from central banks, regardless of the economic collateral damage inflicted. The irony is that UK policymakers will likely have to administer more financial system pain and economic hardship to the British public to ultimately achieve a lasting lowering of inflation they themselves helped sow through years of supercharged fiscal and monetary stimulus in the wake of the pandemic and Brexit shocks. As memories of 2020's COVID-induced economic crater faded, the Bank of England's balance sheet bloated to over £1 trillion, while the UK budget deficit exploded to levels untouched since World War II. This colossal wave of policy accommodation injected directly into private and public sector spending streams stoked tremendous demand just as global supply chains seized up, setting the stage for Britain's inflationary outbreak. While the bank was initially slow to respond and consistently behind the inflation curve, it has more recently shown a zealous commitment to imposing restraint stiff enough to finally quash this insidious inflation cycle. By marching its benchmark interest rate up from 0.1% before the pandemic all the way to 5.25%, the latest hike being delivered in May, the BoE has engineered the most severe tightening of UK monetary conditions since the Black Wednesday crisis of 1992 finally forced Britain out of the European exchange rate mechanism and into a wrenching recession. But even after more than a year of relentless policy rate hikes, with the lagging impact still working its way through mortgage payments, rents, and consumer spending, the BoE continues to warn that the inflation dragon remains unslayed. The reason the old lady of Threadneedle Street seems so unmoved by more encouraging inflation prints like April's is that she has witnessed echoes of this disinflationary siren song before, only to see core price pressures snap menacingly higher as growth rebounds and short-lived bouts of cost relief prove fleeting. This is the monetary policymaker's deepest fear of administering a dose of contractionary medicine insufficient to fully extinguish inflation, only to be confronted with an even more virulent bout of price pressures and having to jam on the economic brakes even harder in response. Slaying inflation rapidly and emphatically, even at the cost of a potentially deeper near-term recession, is preferred to a lingering series of unsuccessful stop-and-start tightening cycles that ultimately demand even harsher policy restraint and greater economic dislocation over time. This philosophy, born of the haunting experience of the 1970s when premature monetary policy pivots allowed inflation to keep reigniting, represents a psychic hardening among the central banking elite. A difficult but committed refusal to pursue the easier, more politically palatable path of prematurely relieving economic pain at the risk of leaving inflation's scourge to systemically undermine growth and living standards for years or decades to come. For critics of austere central bank headhunting, this uncompromising stance can seem unnecessarily cruel and detached from the plight of beleaguered households and businesses. Why keep piling on higher borrowing costs and indiscriminate demand destruction when families are already struggling so mightily with the cost of living crisis? The central banker's rejoinder is that it is precisely this myopic political pressure to prioritize short-term reprieve over lasting stability that has consistently generated policy errors across history, errors that ultimately exact a far heavier economic toll through fractured confidence, distorted pricing signals, and repeated bouts of draconian inflation quashing. With memory of the 1970s great inflation trauma still seared into the modern monetary policy psyche, there is a palpable determination among today's central banking priesthood to uphold the Volcker-Putin-Bagehot principles. Named for former Federal Reserve Chair Paul Volcker, the central banker most revered for breaking the back of America's past inflationary spiral, and 19th-century economic thinkers Knut Wicksell and Walter Bagehot, this doctrine emphasizes, inflation is a pernicious scourge that must be preemptively attacked through restrictive monetary policy before it becomes entrenched in mass psychology. Stable prices are the paramount mandate of a central bank, which must be willing to administer economic pain to safeguard that primacy. Recessions are the inherent byproduct of anti-inflation policy, but avoiding them at all costs ultimately fosters permanently subpar growth. For devotees of the Volcker-Bagehot mindset, today's hesitation among some quarters to acknowledge that interest rates may need to remain restrictive for an extended period shows the same lack of resolve that allowed inflation to spiral out of control 50 years ago. While financial markets may be impatient for central bank pivots and economies to reach the vaunted immaculate disinflation escape hatch, policymakers who buy into hard money orthodoxy see the achievement of lasting price stability incumbent on an unrelenting imposing of domestic demand restraint until the inflation virus has been fully purged. In the UK, we've already seen high-profile corporate casualties like the sudden implosion of the country's third-largest homebuilder Crest Nicholson, which declared bankruptcy amid impossible financing conditions. While undoubtedly a tragedy for employees and investors, most central bankers would view such episodes as unfortunate but necessary sacrifices in service of the greater cause of restoring economic order. As the Bank of England's top brass have made clear, their preference is to risk overcooking the economy now rather than lose their window to definitively stamp out inflation before it becomes entrenched in mass psychology and labor costs. Households and businesses must be assured that we have the willpower to see it through, Bank of England chief economist Hugh Pill said in a recent speech digging in against calls to pause the tightening cycle. To keep inflation expectations anchored requires being willing to stomach periods of potentially sharp deceleration in activity. These are not mere rhetorical flourishes. The BoE's updated forecasts envision UK inflation remaining stubbornly elevated over 5% by year-end, before finally converging to the 2% target by mid-2025. But actually getting there will require 3 more 25 basis point rate hikes from the current 5.25% peak, followed by an extended multi-year period of monetary policy restrictiveness that craters UK growth to an anemic 0.25% in 2024 and nearly flatlining the economy in 2025. Such a grim economic landscape would typically be unacceptable for a democratically appointed central bank operating in a vibrant market economy. But again, as dyed-in-the-wool inflation slayers, the Bank of England is prioritizing the need to overshoot and definitively kill off entrenched trends of inflation even at a heavy near-term cost. Some have questioned whether the BoE may have already cracked the UK economy's inflationary back with its aggressive hiking cycle, especially if the latest slowdown in price growth proves durable. Why keep inflicting economic pain if the mission is already accomplished? But modern central banking doctrine holds that subtle inflection points and temporary reprieves are not enough to declare final victory. As former BoE rate setter Michael Saunders cautioned, 1 or 2 favorable inflation numbers are not a very secure basis for a major policy pivot. The fear is that premature satisfaction could breed a renaissance of destabilizing inflationary psychology and linger wage price spirals. We need only look across the channel to Europe for a prime example of how quickly inflation headaches can cyclically reappear. After celebrating a sharp deceleration to just 6.1% in May 2023, European central bank officials were quickly humbled as summer heat waves sparked new energy shocks and rebounding household consumption stoked intensified service sector inflation pressures. Latest figures from April show Eurozone inflation has relapsed back above 7%. Prompting the ECB to follow through with another punishing 50 basis point rate hike in early May. While each individual economy's inflation surge has played out somewhat differently based on exposure to commodity shocks, labor force dynamics, and housing costs, all the major central banks have been united in their unwavering determination not to let up on restrictive policies until a protracted period of solidly re-anchored inflation expectations has been achieved. From Christine Lagarde's ECB, to Jerome Powell's Fed, to Andrew Bailey's Bank of England, the lines have been clearly drawn. Short-term economic hardship will be willingly incurred as the price of reinstating the crucial inflation-fighting credibility that keeps expectations grounded and allows liberal capitalist democracies to thrive over the long run. Abandoning that credibility and inflation-fighting resolve, even briefly, is viewed as an existential risk to the entire fiat currency system that has enabled the post-World War II era of globalized economic growth and stability. A return to the kind of crippling stagflation of the 1970s would shatter faith in policymakers, fracture financial markets, constrain economic potential, and empower populist demagogues and authoritarian actors whip up grievances against establishment institutions. To modern central bankers, that apocalyptic scenario, playing out vividly today across the slowly disintegrating wreckage of Lebanon's hyperinflation meltdown, represents an intolerable risk they are determined to forestall at virtually any cost. Even if it requires inflicting some of the steepest interest rate shocks and economic contractions across major economies since the days of Paul Volcker's early 1980s recession. While critics will argue such policy masochism is excessive and rooted in an outdated fixation on the horrors of 1970s stagflation, the central banking clerisy has clearly judged the risks of falling behind the inflation curve as too catastrophic to leave to chance. Years of painstaking work re-establishing monetary policy credibility and low, stable inflation cannot be so easily surrendered even if the costs of that defense presently seem disproportionate to the relatively modest inflation overshoots witnessed thus far. As former Bank of England Governor Mervyn King warned at the outset of the current inflation episode, we must not underestimate the risk that present-day policymakers will allow inflation to persist for too long before taking action to bring it back under control. This admonition now reads like a mission statement for global central bankers for whom the greatest sin would be failing to wrestle inflation's resurgent forces back into permanent submission. So while April's slowdown in UK inflation to 2.3% garnered hopeful headlines and brief economic relief, the Bank of England's hawkish voice resolutely refused to join in celebration. Because for the governing monk-like order of central bankers in 2023, no amount of ephemeral disinflationary data can be sufficient to declare the war definitively won. Not until every last lingering inflation pathogen has been ruthlessly exterminated, regardless of the economic body count required. This grim battle plan, pursued with a sense of historical calling in the face of public backlash over tanking growth and living standards, illustrates the almost spiritual zeal driving the worldwide inflation containment crusade. Because in the monetary realm, failure is never viewed as a cyclical, temporary byproduct, but rather an existential breach that augurs societal implosion and civilizational collapse if not snuffed at the source. Dramatic rhetoric to be sure, but such is the psychological tension governing global economic policy in this fateful period, when the foundations of money's credibility and stability are perceived to be under threat from inflationary forces. Even the slimmest risks cannot be entertained by those elevated to protect fiat currency's societal covenant. For critics, this single-minded central banker zeal to indefinitely crucify growth on the cross of disinflation seems like prioritizing arid economic dogma over the well-being of the very public they are meant to serve. Why forsake the prosperity and potential of millions in deference to arcane theories about anchoring inflation expectations? But to the inflation-focused monks presiding over the cathedral of monetary policy, those conventions represent not dusty ideological curios, but eternal sacred texts encoding the fundamental rules allowing modern capitalism and liberal democracy to flourish in the first place. Sustained deviations from that prescribed doctrine are seen as ushering in ruinous entropy, a descent into vicious cycles of currency debasement, public privation, collapsing investment, and authoritarian political capture. The devotional quality with which figures like Jerome Powell and Andrew Bailey speak of re-anchoring inflation speaks to the fundamentally metaphysical nature of their quest. Yes, there are reams of technical economic analysis informing the quantitative particulars of each rate decision. But driving it all is an animating belief that containing price growth within a tightly defined target range isn't just about short-term firefighting, it's about preserving the integrity of money itself as the elemental binding agent of continuously unfolding economic progress and social order. Miss that target range for too long or demonstrate central bank resolve as wavering, and the entire fiat currency/price stability paradigm risks unraveling into a dystopian populist backlash. A scenario where righteous indignation over soaring costs metastasizes into broad-based rejection of institutional authority and mainstream economics more broadly. It is the central banker's sacred charge to not just put out the latest inflation brushfire through clinical rate maneuvers, but to continually revalidate the monetary realm's quasi-religious devotion to low, stable, and calmly presiding price growth across economic cycles. To fail at reasserting that monetary monasticism quickly gets framed as an existential failing, one that could bring the entire framework of globally interdependent finance and macroeconomic management crashing down. The gravity of that cosmic burden goes a long way towards explaining the relentlessness of the inflation lancing campaign currently underway. When the stakes are framed as preserving the modern world's institutionalized financial architecture from apocalyptic demise, no amount of economic pain seems too great for central bankers to inflict in service of completing their righteous mission of purification. Critics may view this as an overly dramatic inflation theology, unnecessarily elevating the importance of bureaucratic groupthink around managing CPI overshoots to the status of civilization-defining struggle between order and chaos. But to those steeped in the peculiar psychology and indoctrination of the central banking elite, there are few greater callings than being charged with upholding the sanctity of money and stable prices, the very economic animating principles they view as empowering all other progress. It is a cosmological role that to outsiders can seem disconnected from pragmatic concerns over jobs, mortgages, and the vicissitudes of business cycles. But from deep within the hushed marble halls of London, Frankfurt, Washington, and other monetary monasteries, the multi-year global inflation saga is being waged as an almost messianic effort to exorcising corrosive price distortions and reaffirm the primacy of centralized policy stewardship over the invisible handiwork powering market economies. So while families struggle under the weight of punishingly high borrowing costs, and corporations shed thousands of jobs to preserve profit margins, it is important to remember the semi-religious sense of supreme duty central bankers have embraced in prescribing such economic bloodletting. A reframing of priorities that has lifted the narrow inflation control function to an all-consuming spiritual imperative guarding the very civilized continuum. Inside this monastic inflation-fighting fraternity, there is an abiding belief their work represents nothing less than the frontline economic defense protecting democratic market institutions from insidious external corrosion and internal backsliding into primal impulses of soft money heresy. It is from this apocalyptic vantage point of perceived existential struggle that the hawkish zeal to defeat inflationary false prophets at all costs arises.